Before we begin, please note that I am not a licensed financial advisor or insurance agent. The information provided in this video is for educational and informational purposes only and should not be considered financial or legal advice. This presentation is intended to provide a general overview, and you should always consult with a qualified professional to discuss your individual circumstances and financial goals before making any decisions. A few years ago, my friend's father, a wonderful man named Robert, passed away. He was a retired mechanic, a proud grandfather, and he'd always told his kids, "Don't you worry about a thing, I've got everything taken care of." And they believed him. They thought his pension and Social Security would handle everything. But after the funeral, the reality set in. The funeral itself cost nearly $12,000. Then came the final medical bills that his insurance didn't fully cover, another $8,000. He still had a small balance on his mortgage and a credit card he'd been using for home repairs. Suddenly, his children, while trying to grieve the loss of their dad, were faced with a mountain of unexpected expenses. They had to pull money from their own savings, from their kids' college funds, just to clean up the financial mess left behind. And the heartbreaking part? It was all completely avoidable. What if I told you there is a financial tool that millions of American seniors overlook, dismiss, or simply believe they're too old for? That could be the single most powerful act of love you can offer your family. A tool that guarantees your final chapter is one of peace and dignity, not one of stress and burden for the people you care about most. I'm talking about life insurance. Now I know what you're thinking. Life insurance? I'm 65. I'm 75. I'm 80. Isn't that ship sailed? Isn't it outrageously expensive at my age? My kids are grown, they can take care of themselves. These are the exact myths we are going to shatter today. This isn't about getting $1 million policy like you would in your 30s. This is about something different. It's about a strategic, affordable plan designed for this specific chapter of your life. Over the next few minutes, we are going to pull back the curtain on the world of senior life insurance. We will show you why it's not just for the wealthy, why it's not too late, and how it can solve problems you might not even realize are heading your family's way. This video will give you the clarity to decide if this is the right move to protect your legacy and give you and your family ultimate peace of mind. Let's get brutally honest for a moment. Nobody likes to talk about this stuff. It's uncomfortable, but facing a difficult truth now can prevent a financial catastrophe for your family later. The first and most immediate reason to consider life insurance in your senior years is for final expenses. Let's talk real numbers in the United States. The National Funeral Directors Association reports that the median cost of a funeral with a viewing and burial is now over $8,000. In many states, it's well over $10,000. Want to be cremated? You're still looking at a median cost of around $7,000 for a viewing and cremation. And these numbers don't even include the cemetery plot, the headstone, or the flowers. We're talking about a bill that can easily climb to $15,000 or even $20,000. Where does that money come from? Do you have that amount sitting in a savings account, liquid and ready to be used? For many, the answer is no. So, the burden falls on your children or your surviving spouse. They are forced to either drain their own savings, go into debt, or even worse, make decisions about your final arrangements based on what they can afford, not on what you would have wanted. A simple, final expense life insurance policy is designed specifically to cover these costs. It's a direct, tax-free cash payment to your beneficiary, often within days of your passing, to pay for the funeral home, the burial, and all the associated costs. It's a way of saying, "Don't worry about this. I've got it handled." It's your final gift, ensuring your family can grieve without the added poison of financial stress. But it goes far beyond the funeral. The second major reason is debt. The idea that people retire debt-free is, for millions of Americans, a complete fantasy. According to Experian, the average American in their 60s has over $100,000 in debt, and even those over 70 still carry an average of nearly $50,000. This isn't just mortgage debt. It's car loans, credit card balances, and especially medical debt. A serious illness in your final years can leave behind tens of thousands of dollars in bills that Medicare didn't cover. When you pass away, that debt doesn't just vanish into thin air. Your estate is responsible for paying it. If you don't have enough cash in the bank, your creditors can force the sale of your assets to get their money back. This means your home might have to be sold. Your car might have to be liquidated. The heirlooms you wanted to pass down could be sold off to pay a credit card company. If you co-signed a loan with a child, or if you live in a community property state, your spouse could suddenly become responsible for your debts. A life insurance policy provides the immediate cash needed to wipe these debts clean. It ensures the assets you worked your entire life to build actually go to your family, not to banks and lenders. It protects your spouse, allowing them to stay in the home you shared. And it preserves the inheritance you intended to leave for your children and grandchildren. This brings us to the third, and perhaps most important reason, legacy. This is where we shift the conversation from a financial product to an emotional one. Life insurance isn't about dying. It's about what you leave behind. It's about love. Maybe you don't have any debt. Maybe you have funeral costs covered. But maybe you want to leave something more. A life insurance payout can be a life-changing gift. It could be the down payment on a first home for a grandchild. It could fund a college education. It could provide a financial cushion for a surviving spouse, allowing them to live comfortably and not have to drastically change their lifestyle after you're gone, especially if your pension or Social Security income is reduced after your passing. It can also be used for charitable giving. Perhaps you have a church, a charity, or an alma mater that you've always wanted to support in a significant way. Naming them as a beneficiary of a life insurance policy can be a powerful way to make a lasting impact and cement your legacy of generosity. It transforms a modest monthly premium into a substantial, tax-free donation that can continue your values long after you're gone. Now, I can hear the biggest objection loud and clear. This all sounds wonderful, but I'm 78 years old with high blood pressure. There is no way I can qualify, and even if I could, the cost would be astronomical. This is the single biggest misconception that stops people from even exploring their options. And it's completely understandable because for a long time it was true. But the insurance industry has evolved dramatically. There are now specific types of policies created just for seniors, some of which require no medical exam at all. These are not the policies you see advertised for young families. They are different. They are designed to be accessible and affordable, even if you have pre-existing health conditions. We're talking about policies that can be secured for a premium that might be less than your monthly cable bill or what you spend on coffee. The key is knowing what these policies are, how they work, and which one is right for your specific situation. And that's exactly what we're going to break down. Forget everything you thought you knew about life insurance, because the game has completely changed for seniors. So let's start with a story. Meet John and Mary. They're in their early 70s, retired, and they did everything right. They worked hard, saved diligently in their 401ks, paid off their house in a nice suburban neighborhood, and raised two wonderful kids who are now grown with families of their own. On paper, they are the picture of a successful retirement. They live on a fixed income from Social Security and their retirement savings, and while they aren't jet-setting around the world, they're comfortable. They enjoy their garden, seeing their grandkids, and their weekly bridge game. Like many people their age, they thought the chapter on life insurance was closed. They had a term policy when the kids were young and the mortgage was a looming giant. But once the house was paid off and the kids were financially independent, they let it expire. Why keep paying for something you don't need, right? Their savings, they figured, would be more than enough to handle, well, the final stuff. Then two things happened. First, their best friends, Dave and Carol, went through a crisis. Dave had a sudden aggressive illness. The last 6 months of his life were a blur of hospital stays, specialized care, and experimental treatments that insurance only partially covered. When Dave passed away, Carol was left not only with overwhelming grief, but also with the mountain of medical debt that their retirement savings was never designed to handle. John and Mary watched their dear friend, a proud and capable woman, have to sell the home she and Dave had built their lives in, just to stay afloat. It was a brutal, heartbreaking reality check. The final stuff wasn't just a funeral. It was a cascade of unpredictable, financially devastating costs that could precede it. The second thing was smaller, but it hit just as hard. Their granddaughter, a bright, talented young woman, got accepted into her dream university. The family was ecstatic, but the scholarship they were counting on didn't come through, leaving a significant gap in her tuition. John and Mary looked at their own finances. They could help, of course, but dipping into their nest egg for that amount would mean cutting back significantly on their own expenses for years. It would change their quality of life. They felt a pang of helplessness, the desire to provide, to leave a legacy, to give their family a head start. That feeling doesn't just disappear when you turn 65. This is the new reality for seniors. The old playbook of pay off the house and you're good is dangerously outdated. We're living longer, but that extended life often comes with higher healthcare costs. And the desire to leave a positive financial impact on our loved ones is stronger than ever. This is where the modern life insurance conversation for seniors begins. It's not about replacing a 40-year-old six-figure income anymore. It's about surgical strategic protection. It's about control. It's about peace of mind. Let's start with the most common and accessible type of policy for seniors: final expense insurance. You might also hear it called burial insurance or funeral insurance. Don't let the name fool you. It's much more than that. Think of this as a financial first aid kit for your loved ones. It's a smaller whole life insurance policy, typically ranging from $5,000 to about $50,000 in coverage. Its primary job is to provide immediate, tax-free cash to your beneficiary to cover all the costs surrounding the end of life. We're talking about the funeral, which can easily cost $10,000 to $15,000 today. We're talking about leftover medical bills, co-pays, and deductibles that Carol had to face. Credit card debts, legal fees to settle the estate, even the cost of a plane ticket for a child who lives across the country to come home. This policy ensures your family isn't scrambling to find cash during the most stressful time of their lives. They won't have to sell assets, drain their own savings, or put expenses on a high-interest credit card. Now you're probably thinking the first big question. Okay, but at my age, that has to be incredibly expensive. This is myth number 1, and it's the biggest reason people don't even bother to look. The truth is, because the coverage amounts are smaller and the purpose is so specific, these policies are designed to be affordable on a fixed income. For a healthy individual in their 60s or 70s, a $10,000 or $20,000 policy can often be secured for a surprisingly low monthly premium. The premium is locked in for life, it will never go up. The death benefit is guaranteed, it will never go down. And it builds cash value over time, which is a nice little bonus. But that leads to the second big question, the one that stops even more people in their tracks. I have some health issues. High blood pressure, diabetes, maybe I had a heart scare a few years back. No one is going to approve me. This is myth number 2. The insurance industry understands that very few people over 60 are in perfect health. That's why there's a whole category of these policies that are incredibly lenient. Many don't even require a medical exam. You just answer some health questions on an application. These are called simplified issue policies. And for those with more significant health concerns, there's an option called guaranteed issue life insurance. The name says it all. You cannot be turned down. As long as you fall within the eligible age range, typically 50 to 85, you are guaranteed to be approved. There are no health questions and no medical exam. This is the ultimate safety net. Now there is a trade-off, and it's important to understand it. These guaranteed policies have what's called a graded death benefit. This usually means that if you pass away from natural causes within the first 2 years of the policy, your beneficiary receives all the premiums you paid in plus interest, typically around 10%. If death is accidental, they get the full face amount from day one. After those first 2 years are up, the full contracted death benefit is paid for any cause of death. It's the insurance company's way of protecting themselves, but for someone who has been told no everywhere else, it is a powerful way to ensure that, at the very least, all the money they put in comes back with interest, and after 2 years their family gets the full intended benefit. But here is where the game has truly fundamentally changed. And if you hear nothing else, hear this. Modern life insurance policies are no longer just about a death benefit. Many of today's policies, even simple final expense plans, come with what are called living benefits, or accelerated death benefit riders. This is revolutionary. These riders allow you, the policyholder, to access a significant portion of your own death benefit while you are still alive if you are diagnosed with a qualifying terminal, chronic, or critical illness. Let's go back to John and Mary's friends, Dave and Carol. Imagine if Dave had a policy with these living benefits. When he was diagnosed with his aggressive illness, they could have accelerated a portion of his death benefit. That money, tax-free, could have been used to pay for that specialized care, to make their home more accessible, to hire in-home nursing help, or simply to relieve the financial stress so they could focus on their time together. It transforms life insurance from a what if I die tool into a how do I live tool. It provides a pool of money to protect your retirement savings from a health crisis. This one feature single-handedly shatters the old idea of life insurance as a sunk cost you never get to see. It's a living, breathing part of a comprehensive financial plan for your later years. So we've covered the foundation. Affordable, accessible policies designed to handle final expenses and protect your loved ones from immediate debt. We've debunked the myths that you're too old, too sick, or that it's too expensive. And we've introduced the game-changing concept of living benefits, which can protect your assets from the massive costs of a late-in-life health crisis. This is the new baseline. This is the essential protection every senior should at least consider. It's about dignity. It's about ensuring your final wishes are a gift to your family, not a burden. Now, hearing that, the first two thoughts that probably jump into your mind are, I'm too old, and it's too expensive. These are the twin giants, the two biggest myths that stop millions of seniors from even exploring their options. They are the reasons why so many well-meaning, responsible people who have done everything right their entire lives accidentally leave behind a financial mess. So let's take a sledgehammer to those myths right now. Let's start with the age myth. I'm in my 60s, my 70s, my 80s. Who is going to insure me now? It's a logical question. For most of your life, life insurance was tied to your youth, your health, your income-earning years. It was about replacing a massive financial loss if a primary breadwinner was gone too soon. But the insurance we're talking about now isn't that. It's a completely different tool for a completely different job. Think of it like this. You wouldn't use a framing hammer to fix a delicate watch. The tool has to match the task. The life insurance you might have had in your 30s was a framing hammer, designed for big heavy-duty work. The life insurance designed for seniors is a precision instrument. It's not meant to replace 40 years of future income. It's designed to provide a specific, calculated amount of cash at a very specific time for a very specific set of needs. And the companies that offer these policies, they know their audience. They are not expecting to insure a 35-year-old marathon runner. They have built their entire business model around insuring people in their 60s, 70s, and even into their 80s. They've created products often called final expense insurance or burial insurance. And many of these policies are what's known as guaranteed issue. Let that sink in. Guaranteed issue. That means for certain policies, typically for people between the ages of 50 and 85, you cannot be turned down for health reasons. There are no medical exams to take, no doctors to see, no one asking you to get on a treadmill. You answer a few simple questions on an application and that's it. The industry recognized a fundamental need. People in their golden years needed a way to cover final expenses without having to jump through impossible health hoops. So they built a product specifically for you. The idea that you are too old is quite simply outdated. It's a relic from a different era of insurance. Today, your age isn't a barrier. It's the very reason these products exist. Now for the second giant, the cost. This has to be ridiculously expensive. They're guaranteeing they'll cover me, so the premiums must be through the roof. Again, this is a hangover from thinking about old-school million-dollar life insurance policies. We are not talking about a policy with a massive payout. We are talking about a modest targeted death benefit. Something between, say, $5,000 and $50,000. Just enough to handle a funeral, clear up any lingering medical bills, and maybe give your kids a small cushion so they don't have to dip into their own savings. Because the payout amount is smaller, the monthly premium is also much smaller. For many seniors, a policy that provides a $10,000, $15,000, or $20,000 benefit can cost less than their monthly cable and internet bill. It can be less than what a couple might spend on a few dinners out. We're often talking about a range of $40 to $150 a month depending on your age, gender, and the benefit amount you choose. And here is the crucial shift in thinking you have to make. You can't just look at the monthly cost. You have to weigh that cost against the alternative. What is the cost of not having it? The cost is your son or daughter, grieving and in shock, getting a call from a funeral director who says, "We require a 50% deposit to proceed." The cost is your family having to sell your belongings, your car, your jewelry, things you wanted them to keep as heirlooms, just to come up with cash quickly. The cost is putting $10,000 or $15,000 of funeral expenses onto a credit card with a 24% interest rate, a debt that could follow them for years. When you compare a manageable monthly premium to that kind of emotional and financial devastation, the true value becomes crystal clear. It's not an expense. It's an investment in your family's stability during their most vulnerable moment. But there's a third myth, a more subtle one. It's the one that well-prepared, responsible people tell themselves. I have savings. I've put money aside in a bank account or an IRA. My kids can just use that. On the surface, this sounds like a perfect plan, but it ignores a brutal reality of our financial system. A person's death triggers an immediate lockdown on their assets. Let me tell you about a gentleman named Robert. Robert was a retired school principal. Meticulous, organized. He had a savings account with $75,000 in it, clearly earmarked for his final expenses and to be an inheritance for his two daughters. He had a will, everything was in order. He told his daughters, "Everything you'll need is in that account. Don't worry." When Robert passed away peacefully at 82, his daughters went to the bank, death certificate in hand, expecting to access the funds to pay for the funeral he had wanted. The bank manager very politely explained that he couldn't help them. Robert's account as a solo account was now frozen. It was officially part of the estate of Robert. To get access, they would have to become the official executors of the estate, which meant taking the will to the county probate court. The court would validate the will, officially appoint them, and only then would they be issued the legal documents, called letters testamentary, that would grant them access to the account. The bank manager told them the process usually takes anywhere from 4 weeks to several months. But the funeral was next Tuesday. The funeral home needed payment now. The airline tickets for family to fly in had to be bought now. The caterer for the reception needed a deposit now. Robert's meticulously saved $75,000 might as well have been on the moon. His daughters, in the midst of their grief, had to scramble. They pooled their own money, borrowed from a relative, and put the rest on credit cards. They were stressed, they were frustrated, and they felt like they'd let their father down, even though they were only following the rules of a system he hadn't fully understood. The money in the bank was eventually released for months later. But the damage was done. The immediate crisis had turned a time of mourning into a time of financial panic. This is the critical difference between savings and life insurance. Savings are part of your estate and are subject to probate, delays, and potential creditors. A life insurance payout is different. It goes directly to the named beneficiary, your son, your daughter, your spouse, and it is not part of the probate estate. The check is typically paid out within days or weeks of the claim being filed. It is tax-free cash, available immediately, to be used for whatever is needed most. It's a dedicated, protected, express lane of funding designed specifically for this moment. It ensures that your family has cash in hand to honor your wishes, without delay, without stress, and without having to use their own money. So, when we look at it clearly, the old arguments against life insurance for seniors just fall apart. The idea that you're too old is false. These products are designed for you. The idea that it's too expensive is a misunderstanding of scale. The cost is minor compared to the financial chaos it prevents. And the idea that your savings are a perfect substitute ignores the critical issues of access, speed, and timing. The real question isn't whether you can get it or afford it. The real question is, what happens to your family in the first few weeks if you don't? Now that we've cleared away the myths, we can get into the specifics. Because not all of these policies are created equal. There are different types with different rules and different waiting periods. Understanding the distinction between a guaranteed issue policy and a simplified issue policy is absolutely essential. Choosing the right one can save you thousands and ensure your family gets the help they need. Choosing the wrong one, well, that can be a heartbreaking mistake. And that's exactly what we need to break down next. So let's get into the nuts and bolts of it. When you start looking for life insurance as a senior, you're going to be staring down two very different paths. On one side, you have what's called term life insurance. On the other, you have permanent life insurance, which includes options like whole life and, more specifically for our purposes, final expense insurance. Think of this as the most important fork in the road you'll face on this journey. One path can lead to peace of mind. The other, for many seniors, leads to a dead end. Let's talk about term life insurance first, because this is where the biggest and most costly mistakes are made. The concept is simple, and on the surface it sounds incredibly appealing. Term insurance is like renting an apartment. You pay a monthly premium for a set amount of time. That's the term. Could be 10 years, 20 years, maybe even 30 years if you buy it when you're younger. If you pass away during that term, your family gets the death benefit. It's straightforward, and here's the kicker that gets everyone's attention. It's usually cheaper, at least at first. An agent might show you a quote for a 10-year term policy and compare it to a whole life policy, and the term policy will look like an unbelievable bargain. You might think, wow, I can get $100,000 in coverage for the price of a few cups of coffee a week. Why would anyone buy anything else? And that right there is the trap. It's a financial Venus flytrap, and millions of seniors have been caught in it. Here's the part they don't put in the big, bold letters on the brochure. For a senior, the term is almost always very short. You're not getting a 30-year term at age 68. You're likely looking at a 10-year, maybe a 15-year term if you're lucky and in perfect health. So let's play this out. Imagine a man named Robert. He's 67, retired, and in decent health. He wants to leave behind about $25,000 to cover his funeral and a few outstanding medical bills so his kids don't have to worry. An agent sells him a 10-year term policy. The premium is low and Robert feels fantastic. He's responsible. He's taking care of business. For 10 years he faithfully pays that premium every single month. Now fast forward. Robert is celebrating his 77th birthday. He's a little slower, has a few more health issues, but he's still enjoying his life. Then he gets a letter in the mail from his insurance company. It's a renewal notice. His 10-year term is over. The letter says he can continue his coverage, but there's a new price. And that new price isn't just a little higher. It's for maybe 5 times what he was paying before. It's a shocking, budget-shattering amount of money. Robert is now 77 on a fixed income and facing a premium he simply cannot afford. But what's his alternative? Try to find a new policy? At 77, with more health conditions, getting new insurance is brutally difficult and even more expensive. So he's faced with an impossible choice. Pay a premium that will cripple his finances, or let the policy go. After 10 years and thousands of dollars in payments, Robert is forced to let his coverage lapse. All that money he paid is just gone. It bought him 10 years of protection, but he outlived it. He's now 77 with no life insurance, and the very problem he tried to solve 10 years ago is now back. Only it's worse because he's older and has fewer options. This isn't a rare story. This happens every single day. Term insurance for seniors is a gamble. You are betting that you will pass away within a very specific and often short window of time. It's a terrible bet to make. Now let's look at the other path. Permanent life insurance, specifically the kind designed for seniors called final expense insurance. This is a type of whole life policy. If term insurance is like renting, whole life is like buying your home. The day you sign the papers, you lock in your monthly payment. It doesn't matter if the housing market goes crazy, if inflation skyrockets, or if you live there for 50 years, your mortgage payment is your mortgage payment. It is fixed. It is predictable. It is permanent. Whole life insurance works the same way. The premium you're quoted on day one is the premium you will pay for the rest of your life. It will never ever go up. Not when you turn 75. Not when you turn 85. Not when you turn 95. It is locked in, guaranteed. The death benefit is also guaranteed. It can never be decreased or canceled by the insurance company as long as you pay your premiums. It doesn't expire. It doesn't matter if you live another 30 years. That policy is a rock-solid promise that the money will be there for your family when the time comes. Okay, you're probably thinking, that sounds great, but it must be incredibly expensive, right? And it's true if you compare the monthly premium of a whole life policy to that initial teaser rate of a term policy, the whole life policy will cost more. But you're not comparing apples to apples. You're comparing a temporary solution to a permanent one. You're comparing a gamble to a guarantee. Over the course of your life, that cheaper term policy could end up costing you far more in renewals, or worse, cost you everything when you're forced to cancel it. The whole life policy, while a higher monthly commitment, provides permanent peace of mind and, in the long run, can represent far greater value because it's guaranteed to actually pay out. But there's another layer to this that makes permanent insurance so powerful, something term insurance completely lacks. It's called cash value. A small portion of every premium you pay into a whole life policy goes into a separate savings component that grows over time, tax deferred. It's like a little hidden savings account inside your insurance policy. After a few years, this cash value becomes a living benefit. It's an asset you can use while you are still alive. Let's say you have a major unexpected expense, a medical emergency, a critical home repair. You can actually take out a loan against the cash value in your policy. You don't have to apply for it, you don't have to get your credit checked. It's your money. It's a safety net. In a worst-case scenario, if you could no longer afford the premiums at all, you wouldn't have to just walk away with nothing like you would with a term policy. You could surrender the policy and receive the accumulated cash value. It ensures that the money you paid in isn't just lost. So when we talk about final expense insurance, we are talking about these permanent, whole life policies. They are specifically designed for seniors to cover these end-of-life costs. The coverage amounts are typically smaller and more focused, say from $5,000 to $50,000. The goal isn't to replace your income or pay off a 30-year mortgage. The goal is to provide immediate, tax-free cash to your beneficiary to handle a funeral, medical bills, and any small debts, preventing that financial burden from falling on them. And here is perhaps the single most important feature for many seniors: the application process. Unlike traditional life insurance that might require a medical exam, A nurse coming to your house, drawing blood, and asking you to step on a scale. Most final expense policies do not require a medical exam. The application is just a series of health questions. And for those with more significant health issues, there are even guaranteed issue policies where you cannot be turned down for health reasons at all. As long as you meet the age requirements, you are approved. This is a game changer. It means that even if you've had health problems in the past, even if you think you're uninsurable, you likely still have options. So let's go back to that fork in the road. Path 1 is term insurance. It looks cheap and easy at the start, but for a senior, it's a path that often leads to skyrocketing costs, canceled policies, and wasted money, leaving your family right back where they started. Path 2 is final expense whole life insurance. It's a permanent solution. The costs are locked in forever. The benefit is guaranteed to be there. And it builds a cash value safety net you can use while you're alive. It is the path built for predictability, for security, and for genuine peace of mind. Choosing the right path isn't just a financial decision, it's an emotional one. It's the difference between leaving behind a question mark and leaving behind a promise that has been kept. But knowing which type of policy is right is only half the battle. The insurance world is filled with hundreds of companies, all claiming to be the best. How do you find a reputable company? How do you compare quotes? And most importantly, how do you avoid the scams and predatory sales tactics that specifically target seniors? That's where we're going next, and it's information you absolutely cannot afford to miss. Alright, let's dive into the practical, the tactical, the stuff that actually gets you from, I should probably look into this, to, I have the right policy from the right company at the right price. This is where the rubber meets the road. The first thing to understand is that the life insurance industry, especially the part that markets to seniors, can feel like the Wild West. You'll see ads on daytime television, get mailers that look like official government documents, and find websites that promise the moon. They are all competing for your attention and your dollar. Our job is to tune out that noise and focus on a clear, methodical process. Let's start with finding a reputable company. This is the foundation. A life insurance policy is a long-term promise. It's a promise that a company will be there 30 years from now to pay your family. You wouldn't trust a promise that big to someone you just met on the street, and you shouldn't trust it to a financially shaky or untrustworthy insurance company. So, how do you check their credentials? There are 3 key things to look at. First, and most importantly, is their financial strength rating. Think of this like a credit score for the insurance company itself. Independent agencies like AM Best, Moody's, and Standard & Poor's do deep dives into these companies' finances. They look at their cash reserves, their investments, how they handle their money, and they give them a grade. These grades tell you how likely that company is to be able to pay its claims, even in a major economic downturn. You're looking for companies with high ratings, ideally an A or better from AM Best. A company with a B+ rating might offer you a slightly cheaper premium, but is that small savings worth the risk that they might not be around to pay the claim when it matters most? Absolutely not. This is a non-negotiable step. Never buy a policy from a company without first checking their financial strength rating. You can usually find this right on their website, or by searching for the company on the AM Best website. Second, look at their customer service record. How do they treat their clients? The best way to find this out is to look at their complaint ratio. The National Association of Insurance Commissioners, or the NAIC, tracks consumer complaints filed against insurance companies. They compile this data into a complaint index. The baseline score is 1.0. A company with a score of 2.0 has twice as many complaints as expected for its size. A company with a score of 0.5 has half as many. You want to find a company with a score below 1.0. This tells you that they resolve issues, they communicate clearly, and they treat their policyholders fairly. Remember, you won't be the one dealing with this company when the time comes, your grieving family will. The last thing you want is for them to have to fight with an unhelpful bureaucratic company to get the benefit you so carefully planned for them. Third, consider the company's history. How long have they been in business? While there are some good new companies out there, when it comes to a promise that could span decades, stability and a long track record matter. You're looking for companies that have been around for 50, 75, even over 100 years. These are companies that have weathered world wars, recessions, and pandemics. They have proven their ability to manage their finances through good times and bad. A long history isn't a guarantee of future success, but it's a powerful indicator of stability. Once you've identified a handful of financially strong, well-regarded companies, it's time to compare quotes. And this is where most people make their biggest mistakes. They either talk to only one agent, or they fill out a dozen online forms and get bombarded with hundreds of phone calls. There's a smarter way. You need to understand the difference between a captive agent and an independent agent. A captive agent works for one specific insurance company. Think of a State Farm or Allstate agent. They can be incredibly knowledgeable about their company's products, but they can only sell you those products. They can't tell you if a competitor down the street has a better policy for you at a lower price, because they don't work for the competitor. An independent agent or a broker is different. They work for you. They are not beholden to any single insurance company. They have contracts with dozens of different carriers. Their job is to take your specific information, your age, your health, your needs, and shop it around to all those different companies to find the best possible fit. They can compare the underwriting guidelines of 10 different A-rated companies and know which one is most likely to give you the best rate for your specific health profile. Working with a good independent agent is like having a professional shopper on your side. It's arguably the single most efficient way to survey the market and ensure you're not overpaying. Now, what about those online quote websites? They can be a useful tool for getting a ballpark idea of costs, but you must use them with extreme caution. Here's the secret: they don't advertise. Many of these sites are not insurance agencies. They are lead generation companies. Their business model is to collect your information, your name, age, phone number, email, and then sell that information to a dozen different agents who will all start calling you immediately. If you've ever filled out one of these forms, you know what I'm talking about. Your phone doesn't stop ringing for a week. If you do decide to use one of these tools for initial research, be smart about it. Use a secondary email address you don't use for anything else. Consider using a Google Voice number instead of your actual cell number. And never, ever give out your social security number or bank account information on a generic quote website. There is absolutely no reason they need that information to provide a preliminary quote. Finally, we have to talk about avoiding the scams and the predatory tactics. This is so critically important because there are people out there who specifically design their marketing to create confusion and pressure you into making a bad decision. Here are the biggest red flags to watch out for. Number 1. High-pressure sales tactics. If an agent ever says something like, "This rate is only available today," or "You have to sign up right now to lock this in," it's a massive red flag. Reputable insurance companies and agents do not operate this way. Rates can change, but they don't typically change from one hour to the next. This is a manufactured urgency designed to stop you from thinking clearly and comparing your options. Your response should be a polite but firm, "No, thank you," and then you should end the conversation. Number 2. The guaranteed acceptance trap. You'll see this advertised everywhere. No medical exam. You cannot be turned down. While guaranteed issue life insurance is a legitimate product, it is almost always the most expensive type of insurance for the amount of coverage you get, and it should be a last resort for those with very serious health conditions who cannot qualify for anything else. These policies always have what's called a graded death benefit. This is the fine print they don't put in the big, bold letters. A graded benefit means if you pass away from natural causes within the first 2 or 3 years of the policy, your beneficiary doesn't get the full death benefit. Instead, they only get a return of the premiums you paid, maybe with a little interest. The full payout only applies after that waiting period is over. Predatory marketers push these policies on everyone, even healthy seniors who could easily qualify for a much cheaper, fully underwritten policy with a day-one death benefit. Number 3. Vague answers and a reluctance to put things in writing. If you ask an agent a direct question about policy fees, exclusions, or the graded benefit period, and they give you a fuzzy, confusing answer, be very wary. If you ask them to email you the full policy illustration and details before you sign anything, and they hesitate or make excuses, that's a sign to walk away. Everything should be transparent and in writing. And number 4. Anyone who asks for your bank account or credit card number to hold a rate or process your application before you've even seen or agreed to the final policy. This is not standard practice. You provide payment information only when you have reviewed the final offer, you are satisfied with the terms, and you are formally accepting the policy. Navigating this process requires a healthy dose of skepticism and a commitment to doing your own due diligence. But it is not an impossible task. By focusing on A-rated companies, working with a trusted independent agent, and knowing the red flags, you can take control of the process. You can cut through the noise and find the right solution that protects your family and gives you that priceless peace of mind. And once you have that policy in hand, there's one more crucial step: reviewing it and making sure it stays aligned with your life. Because a life insurance policy isn't a statue you place in a garden and admire from a distance. It's the garden itself. It needs to be tended, watered, and sometimes you need to pull a few weeds or plant something new. The biggest mistake people make after going through all the trouble of securing a policy is filing it away and forgetting about it. They treat it like a time capsule, to be opened only decades later. But your life is a dynamic, evolving story, and your policy needs to be a living document that reflects the latest chapter. Think about it. The person you were 10, 15, or even 5 years ago had different priorities, different debts, and a different family structure. You bought a policy to protect that person's reality. But is it still protecting your reality today? This isn't about second-guessing your past decisions. It's about honoring your present and future. A regular policy review, maybe every 2 to 3 years or after any major life event, is one of the most powerful and responsible financial moves you can make. It's a checkup for your financial health. So what are these major life events? Let's call them review triggers. The most obvious one is a change in your marital status. If you get married, you'll almost certainly want to add your new spouse as a beneficiary. But what's even more critical, and often tragically overlooked, is divorce. I can't tell you how many heartbreaking stories I've heard about a man who remarried, built a beautiful new life with his second wife for 20 years, but forgot to change the beneficiary on his old life insurance policy. When he passed away, the entire death benefit, a sum meant to protect his current wife, went directly to his ex-wife from decades ago. And legally, there was nothing anyone could do. His will said one thing, but the policy's beneficiary designation said another. And the beneficiary designation on a life insurance policy almost always wins. It supersedes a will. It is a legally binding contract. A 5-minute phone call and a 1-page form could have prevented a catastrophe for the person he loved most. Another trigger is the birth of grandchildren. Suddenly, your vision for the future expands. It's not just about your children anymore. You start thinking about legacy, about giving the next generation a head start. A policy review is the perfect time to see how you can incorporate them. Maybe you want to name them as contingent or secondary beneficiaries, or perhaps you want to carve out a portion of the benefit to be placed in a trust for their education. This is how a simple policy transforms into a multi-generational tool for building family wealth and opportunity. Of course, there are sad triggers too. The death of a spouse or any named beneficiary is a critical moment to review your policy. If your spouse was your primary beneficiary, and you haven't named a contingent beneficiary, the death benefit could be paid to your estate. That sounds okay, but it means the money gets tangled up in the slow, expensive, and public process of probate court. It could be months, even years before your loved ones see a dime, and legal fees could eat away at the total. By simply updating your beneficiaries to your children or a trust, you ensure the money goes exactly where you want it, when it's needed most, bypassing probate entirely. Your financial picture is another huge trigger. Did you pay off your mortgage? That's fantastic. That was likely the single biggest debt your life insurance was designed to cover. You might be in a position now where you can actually reduce your coverage and, in turn, lower your monthly premium, freeing up cash for your retirement. On the flip side, maybe you took on new debt. Perhaps you co-signed a student loan for a grandchild or took out a business loan to pursue a passion project. That's a new liability that needs protection. Your policy needs to be right-sized for your life as it is today, not as it was a decade ago. So what does a review actually look like? Simpler than you think. First, you pull out the physical policy or log into your online portal. The very first thing you check are the beneficiaries. Who is the primary? Who is the contingent? Are their names spelled correctly? Is their relationship to you still accurate? This is non-negotiable. Second, look at the coverage amount. Ask yourself a simple question. If I were to pass away tomorrow, what financial gaps would my family face? Think about final expenses. Funerals aren't cheap. Think about any remaining debts. Think about the income you want to provide for a surviving spouse. Does the number on the page still match the needs in your heart? Third, understand the policy type and its status. If you have a term policy, when does the term expire? This is crucial. Many people are shocked to find their 20-year term policy is about to end, leaving them uninsured at an age where getting new coverage is much more expensive. If you have a whole life or universal life policy, how is its cash value performing? Are the statements you receive matching the projections you were shown when you bought it? This cash value is your asset, and you need to monitor its health just like any other investment. Let me tell you about a woman named Eleanor. She and her husband, Robert, bought policies in their early 50s. The goal was simple. If one of them passed, the other could pay off the house and live comfortably. Robert was Eleanor's beneficiary, and her 2 children were the contingents. Fast forward 15 years. Robert had sadly passed away from a sudden illness. The kids were grown, successful, and had families of their own. Eleanor, now 68, was living alone in the fully paid-off house. She assumed her life insurance was all set. The kids were the beneficiaries now, right? Well, not exactly. Since Robert had passed, her children had been automatically promoted to primary beneficiaries. But it was still split 50-50, just as she'd set it up years ago. But in the intervening years, her son had become a highly successful surgeon, while her daughter was a public school teacher raising 3 kids on a tight budget. Eleanor's desire now wasn't just to split the money evenly, but to provide more support where it was needed most. During a policy review, she made a change. She adjusted the beneficiary percentages to give 70% to her daughter and 30% to her son, a decision she discussed openly with both of them, and which her son wholeheartedly supported. But they discovered something else. Eleanor had a smaller, older whole life policy she'd completely forgotten about, one she'd taken out through a previous employer. It had been quietly accumulating cash value for over 25 years. It wasn't a fortune, but it was a significant amount. That discovery changed everything. She realized she didn't have to wait until she was gone to help her family. Using a policy loan, she accessed a portion of that cash value, tax-free, and gave it to her daughter's family as a down payment for a larger home they desperately needed. The joy and relief she felt, seeing her legacy at work while she was still there to witness it, was immeasurable. That dusty old policy wasn't just a death benefit anymore. It became a tool for living. That is the power of a review. It's not just about dotting I's and crossing T's. It's about realigning your resources with your love. It's about making sure your final act of protection is as wise, current, and thoughtful as you are. But what if you're just starting this journey? Or what if, during your review, you get that sinking feeling that the policy you were sold years ago might have been the wrong one? There are common traps, subtle mistakes in the fine print, and in the sales process that can turn a promise of security into a source of frustration. And knowing what these pitfalls are before you sign, or even as you review, is the key to ensuring your legacy is secure. The first and perhaps most seductive trap is the no medical exam policy. You've seen the commercials. They promise convenience, speed, and no needles. For anyone who's ever felt a little anxious in a doctor's office, this sounds like a dream. But this convenience comes at a steep, often hidden price. Think of it this way. When an insurance company agrees to cover you without knowing your health status, they are taking a massive gamble. And how do they hedge their bet? They do it in 3 ways, and all of them are at your expense. First, the premiums are almost always significantly higher than a policy that requires an exam. You are paying for the privilege of their ignorance. Second, the coverage amounts are typically much lower. You won't find $1 million no-exam policy for a senior. They cap their risk by capping your benefit. But the third and most dangerous catches a little piece of fine print called a graded death benefit. Let me tell you about a man named Richard. At 72, Richard was in decent health, but hated going to doctors. He saw an ad for a $50,000 policy with no exam and thought, perfect. He signed up, paid his premiums faithfully for 18 months. Then, tragically, he suffered a sudden fatal heart attack. His daughter, grieving but trying to handle his affairs, filed the claim, expecting the $50,000 to cover his funeral and pay off his last few medical bills. A few weeks later, she received a check not for $50,000, but for a little over what Richard had paid in premiums. She was confused, then devastated, then angry. Buried in the policy was a 2-year graded death benefit clause. This clause states that if the insured person dies from natural causes, like a heart attack, stroke, or cancer, within the first 2 or sometimes even 3 years of the policy, the insurance company does not pay the full death benefit. Instead, they simply refund the premiums you paid, sometimes with a small amount of interest. The full coverage only kicks in after that waiting period is over. They sold Richard a policy that, for the first 2 years, was little more than a low-interest savings account. And sadly, this happens every single day. This leads directly to the second major pitfall, the guaranteed issue illusion. These policies are often the same ones that don't require a medical exam. The sales pitch is powerful. You cannot be turned down. For someone who has a few health conditions and is worried about being denied, this sounds like the only option. But guaranteed issue, is the most expensive life insurance you can buy for the least amount of coverage. The insurance company is insuring a complete unknown. They assume the absolute worst about your health and charge you accordingly. The problem is many seniors who have their health conditions well managed, maybe with medication for blood pressure or controlled diabetes, assume they won't qualify for anything else. They see the guaranteed label and jump on it, not realizing they are likely overpaying by a massive margin. They could have qualified for a standard policy with a simple medical exam that would have given them twice the coverage for half the cost. Don't let the fear of denial push you into the most expensive corner of the market without exploring all your other options first. The third pitfall is a fundamental misunderstanding, often encouraged by agents, about the type of policy you're buying. It's the classic battle: term versus whole life. Let's break it down simply. Term life insurance is like renting. You pay for coverage for a specific term, say 10 or 20 years. If you pass away during that term, it pays out. If the term ends, the coverage is gone, just like you stop having a place to live when your lease is up. It's much cheaper because most people outlive their term. Whole life insurance is like owning. It's designed to last your entire life, as long as you pay the premiums. It's more expensive, but it's permanent and builds a cash value. Here's the trap for seniors with each. For term insurance, an agent might sell a 70-year-old a 10-year term policy. The premium looks wonderfully affordable. But what happens at age 80? The term expires. The coverage vanishes. And the cost to get a new policy at 80 years old? It's astronomical if you can even find one. You've essentially paid for a decade of protection, only to be left uninsured at the very age when you're most likely to need it. The trap with whole life is the opposite. A commission-hungry agent might push a large, expensive whole life policy on someone with a fixed income, focusing on the cash value and investment aspects. Let me tell you about Margaret. She was 68, and an agent convinced her that a $100,000 whole life policy was a great way to build a nest egg for her grandkids. The premiums were nearly $400 a month. For 5 years she scraped by, pulling from her savings to make the payments. Then she had a medical emergency, and the money simply wasn't there. She had to choose between her policy and her prescriptions. She let the policy lapse. All the thousands of dollars she had paid in were gone. The small cash value she had built was eaten by fees. She lost everything. The right policy is one that you can comfortably afford for the rest of your life. A policy that lapses because the payments are too high protects no one. This brings us to the fourth pitfall: the pressure cooker sales process. Life insurance is an emotional product. It deals with love, legacy, and mortality. Unscrupulous agents can exploit these emotions to rush you into a decision. They'll use phrases like, "This rate is only good for today," or "You need to lock this in before your birthday next week when the price will go up," or the classic, "If you walk away from this today, what will happen to your family tomorrow?" These are red flags. This is not a decision to be made under pressure. A good, ethical advisor will want you to be 100% comfortable. They will encourage you to take your time, to review the documents, and even to discuss it with your children or a financial advisor. If you feel rushed, if you feel like you're being backed into a corner, that is your signal to walk away. You are in control. It is perfectly acceptable, and in fact it is wise to say, "Thank you for the information. I need a few days to review this with my family." A legitimate professional will respect that. Someone focused only on their commission will not. Finally, the fifth and most common mistake is simply not shopping around. You wouldn't buy the first car you test drive or the first house you tour. Yet, many people will sign up for the first life insurance policy they're quoted. Rates for the exact same person can vary by hundreds, even thousands of dollars a year between different insurance companies. Some companies are more favorable to individuals with diabetes. Others have better rates for people who have well-controlled high blood pressure. Some are more lenient with weight. If you only talk to one agent, especially a captive agent who only works for one company, you will only ever hear about the products that one company sells. They can't offer you a better deal from a competitor because they aren't allowed to. The key is to get multiple quotes. You can do this by working with an independent broker who represents many different companies, or by using trusted online comparison tools. Getting at least 3 to 5 quotes is the single best way to ensure you are not overpaying. It takes a little extra time, but that time could save you and your family a fortune over the life of the policy. Now, when you're getting those quotes, you're going to see a few different names and types of policies pop up, and this is where a lot of people get confused. It's not just term versus whole life anymore. When you're over 60, a few specialized options enter the picture: designed specifically for seniors. Understanding them is the key to not just getting a policy but getting the right policy. Let's start with the one you'll see advertised on late-night television. The one that sounds almost too good to be true: Guaranteed Issue Life Insurance. The name says it all. You are guaranteed to be approved. There are no medical questions. None. You could have had a heart attack last week and you would still be approved. There's no physical exam, no blood test, no one digging through your medical records. For seniors who have battled significant health issues, this can feel like a life raft. It's a way to secure some coverage when every other door has been slammed shut. But, and this is a massive but, this guarantee comes at a steep price and with some very important strings attached. First, the premiums are the highest of any type of life insurance dollar for dollar. The insurance company is taking a huge risk by not asking about your health, and they price the policy accordingly. They are essentially betting that, on average, the high premiums they collect from the group will cover the payouts. Second, the coverage amounts are typically very low. You won't be finding a $1 million guaranteed issue policy. You're usually looking at face amounts between $5,000 and $25,000. It's designed not for replacing income, but for covering final expenses, a funeral, outstanding medical bills, or a small credit card debt. And here is the most critical string attached, the one that many people miss in the fine print: the graded death benefit. This is non-negotiable, so please listen closely. With most guaranteed issue policies, if you pass away from natural causes like an illness within the first 2, sometimes 3 years of the policy, your beneficiary does not get the full death benefit. Instead, they get a return of all the premiums you paid, usually with a little interest, maybe 10%. The full death benefit is only paid if you die in an accident during that initial period, or from any cause after the 2 or 3 year waiting period is over. This is the company's protection against someone who knows they are terminally ill buying a policy on Monday, and their family collecting a huge payout on Friday. It's a necessary feature for the company, but it's something you absolutely have to know about before you sign on the dotted line. Now, one step up from that is something called Simplified Issue Life Insurance. Think of this as the middle ground. It's for seniors who are in reasonably good health but maybe have a few managed conditions like high blood pressure or cholesterol. With Simplified Issue, there is still no medical exam. No needles, no nurses coming to your home. But unlike Guaranteed Issue, there are health questions on the application. They'll ask things like, in the last 2 years, have you been treated for cancer? Or have you ever been diagnosed with HIV? They'll also check your prescription drug history and your driving record electronically. You have to be able to answer no to the major knockout questions to be approved. Because the insurance company is taking on a little less risk than with a guaranteed policy, the premiums are lower and the available coverage amounts are higher. You can often get a policy for $50,000, $100,000, or sometimes even more. And the best part? There is usually no graded death benefit. If you are approved and you pay your first premium, your coverage is active from day one. If you pass away a month later from an illness, your family gets the full face amount of the policy. For the majority of seniors who are managing their health but aren't critically ill, Simplified Issue is often the sweet spot. It offers a balance of convenience, affordability, and meaningful coverage without the hassle of a full medical exam. Both of these policy types are often sold under the umbrella of final expense or burial insurance. Don't let the names fool you. These aren't special legal types of insurance. They are just marketing terms for smaller whole life policies, usually guaranteed or simplified issue, designed to cover those specific end-of-life costs. The money can be used for anything your beneficiary chooses, but the amounts are tailored to handle the average cost of a funeral, which, as of 2023, is hovering between $8,000 and $10,000 in the United States. Now that you know the main options, let's talk about the 5 biggest mistakes seniors make when buying this coverage. Avoiding these pitfalls is just as important as picking the right policy. The first and most heartbreaking mistake is waiting too long. I cannot stress this enough. Life insurance is one of the few things in life you buy with your health, not just your money. Every single birthday you have makes your premium more expensive. But it's not just about age. A health scare can happen overnight. One day you're perfectly healthy and can qualify for the best rates. The next, you have a diagnosis that either disqualifies you completely or pushes you into a much more expensive, guaranteed issue policy. The difference between applying at 67 versus 70 isn't just 3 years. It could be a 50% increase in your premium, or the difference between getting coverage and being denied. If you are even considering it, the best time to act is right now. The second mistake is buying the wrong amount of coverage. Some people, in a panic, buy the first $5,000 policy they see advertised, assuming it will be enough. Then their family is left with a massive shortfall when they discover the funeral alone costs twice that. On the other end, some people are convinced they need a $200,000 policy to leave a legacy, but the premium is so high that they can't afford it after a few years, and the policy lapses. You lose all the money you paid in and have no coverage. The key is to sit down and do the math. Add up your debts, the estimated cost of a funeral in your area, any final medical bills, and maybe a small cushion for your spouse or family. Buy what you need and what you can comfortably afford for the long haul. The third mistake is not understanding that graded death benefit we talked about. People buy a guaranteed issue policy, they're so relieved to be approved they pay their premiums for 18 months, and then they pass away from a sudden illness. Their family, grieving and vulnerable, files a claim expecting a $20,000 check to pay for the funeral. Instead, the insurance company sends a check for the $2,000 in premiums that were paid, plus a couple hundred in interest. The family is left confused, angry, and in a terrible financial bind. It's not a scam, it's the contract they agreed to. You have to know the rules of the game you're playing. If you buy a policy with a graded benefit, you have to understand and accept that 2-year waiting period for the full payout on natural death. The fourth mistake is being dishonest on the application. This applies to simplified issue policies. You might be tempted to fudge a little on the health questions, to say you quit smoking 2 years ago when it was really only 6 months. You might think, there's no medical exam, how will they ever know? They will know. Every policy comes with a contestability period, which is legally the first 2 years the policy is in force. If you pass away during this period, the insurance company has the right to launch a full investigation. They will pull your medical records, and if they find that you lied about a material fact on your application, a material misrepresentation, they can and very likely will deny the claim. They will simply return the premiums to your family and void the policy. The momentary discomfort of being honest about a health condition is nothing compared to the devastation your family will feel if the promise you made to them is broken because of a lie. Finally, the fifth mistake is a legal one, naming a minor as a direct beneficiary. You may want to leave the money directly to your grandchild. It's a beautiful thought, but an insurance company cannot legally pay a 6-figure death benefit to a 12-year-old. Doing this creates a legal nightmare. The court will have to appoint a guardian to manage the funds, a costly and time-consuming process that will eat away at the inheritance. Instead, you should either name a trusted adult to be the beneficiary, or better yet, set up a trust for the child and name the trust as the beneficiary. This ensures the money is managed responsibly according to your wishes. It's a simple step that avoids a world of complication for the people you are trying to protect. Now, these kinds of specific beneficiary designations are not just about avoiding legal headaches for minors. They are about control and certainty. They ensure your legacy unfolds exactly as you envision it. But this leads us to one of the single biggest, most catastrophic mistakes people make with their life insurance policies, a mistake that can completely derail your intentions and cost your family dearly. And that is naming your estate as the beneficiary. On the surface, it seems logical, right? Just leave it to my estate, and the will can sort it all out. It sounds clean and simple. In reality, it is the exact opposite. When you name your estate as the beneficiary, you are not handing your family a tax-free check. You are throwing that money into a legal meat grinder called probate. Probate is the court-supervised process of validating a will and distributing a deceased person's assets. And here's the problem. Life insurance proceeds are normally shielded from this process. They pass directly to your named beneficiaries, outside of your will, outside of probate court. It's one of their greatest superpowers. But the moment you name my estate as the beneficiary, you strip the policy of that power. You voluntarily drag that money into the probate system. And what happens in probate? First, delays. A simple probate process can take months. A complicated one can take years. During that entire time, the life insurance money your family might desperately need to pay for the funeral, the mortgage, or daily living expenses is frozen, locked away by the court system. Second, costs. Probate isn't free. There are court fees, legal fees, and administrative costs, all of which get paid out of the estate's assets, including that life insurance money you wanted your family to have. Third, and most importantly, creditors. When money goes into your estate, it becomes available to any and all of your outstanding creditors. Did you have a car loan? Unpaid medical bills? Credit card debt? The creditors get first dibs on the estate's assets, and that now includes your life insurance death benefit. A policy you bought to protect your spouse could end up paying off a hospital or a credit card company, leaving your loved ones with a fraction of what you intended, or even nothing at all. Imagine this scenario. A gentleman named Robert worked his whole life and meticulously paid the premiums on a $200,000 life insurance policy. He thought he was doing the right thing by naming his estate, figuring his will would divide it evenly between his two children. When Robert passed, he had $100,000 in unforeseen medical debt from his final illness. Because the life insurance money went into the estate, his creditors had a legal claim to it. After a year tied up in probate, and after legal fees, the creditors were paid first. His children ended up splitting what was left, which was less than $75,000. Robert's entire plan to provide for his children was decimated by a single checkmark in the wrong box. The simple act of naming his children directly as beneficiaries would have avoided all of it. The full $200,000 would have gone to them, tax-free, within weeks of his passing, completely untouchable by his creditors. This brings us to the second most common beneficiary blunder: failing to keep your designations updated. A life insurance beneficiary designation is a legal contract, and it supersedes your will. I want you to hear that again. It supersedes your will. It doesn't matter what your will says. If your life insurance policy lists your ex-spouse from 30 years ago as the beneficiary, then your ex-spouse is getting the money. Period. Life changes. People get married, they get divorced, they have children, beneficiaries pass away. It is absolutely crucial to review your beneficiary designations every few years, and especially after any major life event. Think of it as a financial fire drill. You hope you never need it, but you have to make sure it works. Too many families have been torn apart by the discovery that a long-forgotten policy is now legally obligated to pay an estranged ex-partner, while the current spouse and children get nothing. Don't let that be your family's story. Now, for those of you with a more substantial estate, there's a more advanced strategy we need to talk about. It's a powerful tool that can take your legacy planning to a whole new level, especially when it comes to minimizing taxes. It's called an irrevocable life insurance trust, or an ILIT. That sounds complicated, but the concept is actually pretty straightforward. An ILIT is a special type of trust that is created for the sole purpose of owning your life insurance policy. Instead of you owning the policy, the trust owns it. You create the trust buys the policy, and you make financial gifts to the trust each year so the trustee can pay the premiums. So why go through all this trouble? One massive reason: estate taxes. As of right now, the federal estate tax exemption is quite high, but that's not permanent, and many states have their own much lower estate tax thresholds. If the value of your life insurance policy is included in your estate, it could push your total net worth over that exemption limit, triggering a hefty tax bill for your heirs. We're talking about a tax that can be as high as 40%. But when an ILIT owns the policy, the death benefit is not considered part of your estate. It's outside of it. That means the entire payout, every single dollar, goes to the trust and its beneficiaries, completely free of federal and state estate taxes. For a multi-million-dollar policy, this technique alone can save your family hundreds of thousands, or even millions of dollars. The ILIT also provides all the other benefits of a trust. It gives you creditor protection for your beneficiaries. It allows you to set the terms for how and when the money is distributed, protecting a young heir from their own immaturity or a spendthrift heir from themselves. It provides immediate liquidity for your family. They can use the trust money to pay any estate taxes that are due on your other assets, like a family business or real estate, so they don't have to sell those assets in a fire sale just to pay the IRS. The key word here, however, is irrevocable. Once you set it up and transfer the policy into it, you can't just change your mind and take it back. You give up ownership and control. That's the trade-off for the incredible tax benefits. This is not a do-it-yourself project. Setting up an ILIT requires the expertise of an experienced estate planning attorney to ensure it's drafted and managed correctly. But for the right person, it's one of the most effective wealth preservation tools available. Finally, let's talk about a use for life insurance that goes beyond family. Let's talk about legacy. Many people have a deep desire to support because they believe in a church, a university, an animal shelter, a medical research foundation. They want to leave a lasting mark on the world. Life insurance can be an incredibly powerful and cost-effective way to make a truly transformative charitable gift. There are a couple of ways this works. The simplest way is to just name a qualified charity as the beneficiary, or a partial beneficiary of your policy. When you pass away, the charity receives the death benefit tax-free. You could have a policy where 80% goes to your kids and 20% goes to your alma mater. It's a simple way to leave a much larger gift than you might have been able to afford from your savings. But there's an even more elegant way. You can transfer ownership of an existing policy or purchase a new one and make the charity the owner and the beneficiary. Why would you do this? For the tax benefits while you're still living. The moment you transfer the policy, you can generally take an immediate charitable income tax deduction. And every year after that, when you donate money to the charity so they can pay the policy premiums, those donations are also tax deductible. So you get a tax break now, and the charity gets a massive, game-changing windfall later. You are essentially leveraging relatively small, tax-deductible premium payments into a monumental future gift. For a nonprofit operating on a tight budget, a $50,000 or $100,000 check from a life insurance policy can be the gift of a lifetime, funding their mission for years to come, all in your name. It's a way for a person of average means to leave a millionaire's legacy to a cause they love. Now let's bring that idea of legacy down from the clouds and into the living room. Because for most of us, legacy isn't about having our name on a library or a hospital wing. It's about the people we love sitting right there on the couch. It's about making sure that when we're gone, their lives are easier, not harder. That's the real legacy. And that's what this is all about. Over the last 9 parts, we've explored this topic from every angle. We've talked about the quiet dignity of covering your own final expenses, ensuring your children don't have to start a GoFundMe just to afford a proper farewell. A funeral can easily cost $10,000, $15,000, even $20,000 today. That's not pocket change. It's a major financial shock, dropped on a family at the absolute worst possible moment. A small, simple life insurance policy absorbs that shock completely. It's a final act of planning, a final gift of peace. We discussed the mortgage. For many seniors, the house is paid off, and that's a wonderful achievement. But for millions of others, there's still a balance. Maybe it's a primary mortgage, maybe it's a home equity line of credit. Imagine your surviving spouse already dealing with immense grief, now facing the reality that their income is cut in half because your pension or Social Security is gone, but the full mortgage payment is still due on the first of the month. That's a terrifying position to be in. Life insurance can be the bridge. It can be the tool that pays off that mortgage, that removes the single biggest source of financial stress, and allows your partner to stay in the home they love, surrounded by memories, without the fear of foreclosure. We talked about leaving a tax-free inheritance. You've worked your entire life. You've saved, you've sacrificed, you've built something. You want to pass that on to your kids or grandkids, but assets can be complicated. A house has to be sold. An IRA or 401k comes with a massive tax bill for your heirs. But the death benefit from a life insurance policy? It passes to your beneficiaries 100% income tax-free. It's clean. It's fast. It's a check that arrives in a matter of weeks, not months or years, bypassing the lengthy and expensive probate process. It's the most efficient way to transfer wealth and give your family a true head start. We even talked about using it to equalize inheritances. Maybe you gave one child the down payment for their house years ago. Maybe another child runs the family business and will inherit that. How do you make it fair for your other children? A life insurance policy with them named as the beneficiary is the perfect, elegant solution. It avoids resentment and ensures every child feels equally loved and valued. But I know what you might be thinking through all of this. It's the same 2 thoughts that stop most seniors from ever even exploring this. Thought number 1. This all sounds great, but I'm on a fixed income. I can't afford it. And thought number 2. Even if I could, I'm too old. My health isn't perfect. No one is going to approve me. Let's dismantle those 2 myths right now, because they are costing families fortunes and causing needless anxiety. First, the idea of affordability. When we hear life insurance, many of us picture the massive term policies we might have had in our 30s or 40s, the ones designed to replace our entire income for decades. That is not what we're talking about here. For a senior, the goal is different. You're not replacing 30 years of income. You're solving specific, final problems. And for that, you can get policies that are surprisingly affordable. We're talking about final expense insurance, sometimes called burial insurance. These are smaller, whole-life policies with face values that might range from $5,000 to $50,000. The premiums are designed to be manageable on a fixed income. For many people, a policy that is more than enough to cover a funeral, pay off final medical bills, and leave a little extra behind can cost less than their monthly cable bill. It often comes down to the cost of a few cups of coffee a week. The question isn't just, can I afford the premium? The real question is, Can my family afford the consequences if I don't? Now for the second myth, the big one, eligibility. I have high blood pressure. I'm a diabetic. I had a heart scare a few years ago. I'm in my 70s. You think the door is closed, but in the world of insurance for seniors, there is a special key that unlocks that door for almost everyone. It's called Guaranteed Issue Life Insurance. Let me repeat that: guaranteed issue. It is exactly what it sounds like. If you are within the eligible age range, typically 50 to 85, you cannot be turned down. There are no medical exams to take. There are no needles, no nurses coming to your house. And most importantly, there are no health questions to answer. It doesn't matter if you have a pre-existing condition. Your acceptance is guaranteed. Now, how can they do this? Sounds too good to be true. There is a trade-off, and it's important to understand it. These policies have what's called a graded death benefit. This usually means that if the insured person passes away from natural causes within the first 2 years of the policy, the beneficiaries don't receive the full face amount. Instead, they typically receive a return of all the premiums paid, plus interest, often around 10%. So, your family is guaranteed to get back more money than you put in. If death is accidental, however, the full benefit is usually paid from day one. And once you pass that 2-year mark, the full tax-free death benefit is in force for the rest of your life, no matter the cause of death. This 2-year waiting period is how the insurance company protects itself from someone who knows they are terminally ill signing up on their deathbed. It's what makes it possible for them to offer a policy to everyone, without asking a single health question. For millions of seniors who thought they were uninsurable, this is a revolutionary option. It provides a concrete, guaranteed safety net where none existed before. So let's put this all together. Let's move past the numbers and the policy names and talk about what this really is. This isn't a financial product. It's a peace of mind product. It's the ability to lay your head on the pillow at night and know, with absolute certainty, that you have taken care of your final responsibilities. That your love for your family has been translated into a tangible, practical plan. Imagine the day comes. Your family is gathered. They are heartbroken. They are navigating a world that feels empty without you. In the midst of that grief, do you want them to also be facing a stack of bills? Do you want them whispering in the kitchen, worried about how they're going to pay for the casket, the service, the headstone? Do you want them to have to sell your treasured possessions just to cover your debts? That chaos, that stress, that financial panic becomes part of your final memory. Now imagine a different scenario. The grief is still there, of course. That's the price of love. But there is no financial panic. A few weeks after the service, a check arrives. It's not a fortune, but it's enough. It's enough to pay the funeral director in full. It's enough to pay off that lingering credit card balance. It's enough to cover the mortgage for a few months while your spouse figures things out. It's enough to give them breathing room. That check is a final love letter from you. It says, "I thought of you. I planned for this." You don't have to worry. Just focus on healing. It transforms your final memory from one of stress to one of profound foresight, care, and love. That is the power you have right now. This isn't about being morbid. It's about being responsible. It's about being a protector, a provider to the very end and beyond. So what is the next step? It's not to run out and buy a policy tomorrow. The next step is simply to get information. Your first action is to have a conversation. Talk to your spouse. Talk to your kids. Ask them, if something happened to me tomorrow, would you be prepared financially for the costs? It might be an uncomfortable conversation, but it's one of the most loving conversations you can have. Your second action is to explore your options. Look for an independent insurance agent who specializes in senior products. They can compare quotes from multiple companies to find the best fit for your specific age, budget, and needs. Be wary of anyone who pressures you. This is your decision on your timeline. Your third action is to get a free, no-obligation quote. Find out what it would actually cost. Don't guess. Don't assume it's too expensive. Get the real numbers. Takes a few minutes and it gives you the power of knowledge. Once you have the information, you are in control. You can decide if it's right for you. Maybe it is, maybe it isn't. But you'll be making that choice based on facts, not fear or assumption. You've spent a lifetime building, protecting, and providing for your family. This is simply the final piece of that beautiful puzzle. It's the capstone on a life of love and responsibility. It ensures that your legacy isn't one of debt and distress, but one of peace, security, and a love that continues to provide long after you're gone. Take the first step. Get the information. Protect your legacy.